And good morning. Welcome back once again, options traders, and happy Wednesday. And I received an email from one of our traders saying, how do you figure out how many ratio spreads you have? And he was asking because he was trying to enter an order. Many of the brokers are going to require that you specify how many spreads you have. Some will do it automatically. But if you have to name the number of spreads, it's not always an easy task. But I'm going to show you a simple way. There's a little bit of math, but don't worry, it's a surefire method to get the right answer. So what is that and how do we figure this out? Well, before we get started, please be sure to click like and subscribe. Definitely helps to promote the channel and is so much appreciated. So first off, what is a ratio spread? A ratio spread, like all spreads, requires the purchase and a sale, but they're not always in the same ratios. So for a ratio spread, we have to either be using all calls or all puts, and it's where we're going to buy an option, but we're going to sell more options at a different strike. Now again, they both have to be calls or puts. So for instance, let's say that you buy 5 $100 calls, but you sell 10 of the 105 calls. That is a ratio spread. Notice that on a net contract basis, we have naked options up here. We're long 5, but we're short 10. Now, if we took the trade on the opposite side, that would be called a backspread, and it's going to just have the exact inverse profit and loss diagram. So let's take a look at this exact spread right here, buying 5, selling 10, and that's this one right here in red. And so there's our strike at 100, our bend, and when we come up here, notice if we were short 5 as well, we would flatten out. We would have a vertical spread, but we're short 10. And so we come off this way into potentially unlimited losses, and that's one of the things that makes a ratio spread so dangerous. Now the trader on the opposing side would be this in blue. Notice that it's just the mirror image. That trader is going to end up with losses if the stock stays relatively neutral, but will end up with unlimited gains if the stock in fact makes a large move. But regardless of which one you take, whether it's the trade in red or the one in blue, you have to know how to break it down into your basic units. So all strategies must be broken down into basic units. What does this mean? Well, there's just certain ratios that all strategies are built on. So a vertical spread, for example, is always in a 1-to-1 ratio. That means that for every call you buy, there's one that you sell. If you buy 5, you would sell 5. A butterfly spread, on the other hand, is always in a 1-to-2-to-1 ratio. And in this case, it means you're long 1, short 2, long 1. If you wanted to put on a trade for 2 butterflies, it would be in a 2-4-2 ratio. But notice it's still a 1-to-1 ratio done twice. So why is this important? Well, if you don't enter these proper units, the trade will get rejected. You see, an exchange cannot fill this in a 1-to-3-to-1 ratio or a 2-to-4-to-3 ratio. They can't say that those are just the only options that they could get filled for you. It's always got to be in this ratio. So how do you figure this out? Sometimes it's easy, other times it's not so easy. So the method I want to show you is by understanding prime numbers. This is a super easy, surefire method, but yes, it does mean that you must be able to break numbers down into prime numbers. So recall that a prime number can only be divided by 1 and itself. Now this of course means that we can divide evenly into the number. So for example, 7 is prime. 1 and 7 are the only numbers that can divide evenly into 7, right? 2 can't divide, at least not evenly. 3, 4, 5, 6 can't. 1 and 7 are it. However, 10 is not prime, and that's because 1 will always be an answer. 1 can always divide into it. But in the case of 10, we could also divide by 2, we could divide by 5, and we could divide by 10. So all of these divide into 10, not just 1 and 10. So 10 is not prime. So for your ratio spreads, sometimes it will be very easy to figure out the number of spreads. So for instance, let's say that you buy 10 and sell 20. Well, you should be able to look at that and see that 10 is the largest number that goes into both. We would say that 10 is the largest factor. So you're simply buying 10 spreads. However, you're doing this in a 1-by-2 ratio. For every one you're buying, you're selling 2. So some brokers will show that as buying 10 spreads in a 1 by -2 ratio. Other brokers are going to recognize that this is technically a short spread, and so they'll call it -10 1 by 2. And because you know that it's a short spread, you would just know that you are selling more options than you're buying. But this is the tricky number to figure out. How many spreads are you buying? In this case, it's 10, but they must be filled in a 1 by 2 ratio. So once again, this is fairly easy. Kind of easy to see that 10 is the biggest number that goes into both. But let's look at some that aren't so easy. Let's say that you wanted to buy 12 and sell 30. Well, what you do is you just break each side down into primes, and it turns out it doesn't matter. I could choose 12 and 1, I could choose 3 and 4, 6 and 2. You're going to get the same answer. So let's just say that for some reason I see that 3 times 4 are factors of 12. 3 is prime, but 4 isn't, because 4 can be broken down into 2 by 2. So let's bring this down and say that it's 3 times 2 times 2 equals 12. But notice that all of these are now primes. Now let's do the same thing for 30. Let's say that I immediately see that 15 times 2 might be some factors. 2 is prime, but 15 is not. 15 could be broken down into 3 times 5, and then times 2. Now all of these are prime. Next, what you do is you find how many common factors they have. So notice that both sides have a 3, and both sides have a 2, and that's it. So we multiply these out. 6, there's your answer. It is 6 spreads in a 2 by -5 ratio. I can tell it's 2 by -5 because 6 times 2 would give me 12. 6 times -5 would give me 30. Again, some brokers might show that as a -6 spreads, 2 by 5. All right, so let's try a second one. Let's say you wanted to buy 21 and sell 28. Well, I might say 21 can be broken down into 3 times 7. Both of those are prime. 28 can be 4 times 7. 7's prime, but 4's not. So let's break 4 down again. 2 times 2 times 7. What do we see? Well, we've got a 7 on the left. I have a 7 on the right. And looks like nothing else in common. So that tells me that there are 7 spreads in a 3 by -4 ratio. 7 times 3 would give me the 21. 7 times -4 gives me the short 28. As before, some brokers might show that as -7, 3 by 4. Now, some brokers will do this for you automatically, others won't. And if they don't do it for you automatically, this is the key number that you need to know how to figure out. Otherwise, the trade will get rejected. So let's jump over to Thinkorswim and E-Trade and see how these brokers enter these ratio spreads for you. So now we're into the Thinkorswim platform. We can choose ratio or backspread right here. And let's say that we wanted to, I'm just going to pick a strike down here. I'm going to make changes down here. Let's use the example that we did before. Let's say that we wanted to buy 21, but we wanted to sell 28. So let's make that 28. So if we go over to confirm and send, take a look at what it's telling us. It shows it that it's a short spread. There it is, -7, 4 by -3. That's exactly what we came up with, but that's really the tricky number right there. How many spreads? Is that it's short 7. Now notice the math can get a little tricky here because they're saying -7, 4 by -3. If you take 4 times -7, you get -28, which is what we showed in the presentation. And then -7 times -3 is +21. See, this is why it can get tricky, but they automatically figure out that you are doing 7 spreads. So if you're using Thinkorswim, you don't really need to know this method because all you have to do is to enter the number that you're buying, the number that you're selling, and it will figure out the rest for you. Let's go over to E-Trade and see what it looks like in that platform. So now we're into E-Trade. Now E-Trade, interestingly, does not even allow a ratio spread from its list of kind of standardized strategies, but you can still do it. So we're using Exxon here, 111 is the current stock price. Let's say we wanted to buy the 108 strike. Let's come over here and buy it. Now over here, right there, it says add option. So we can kind of construct our own. Let's make it a sell. So let's say we wanted to buy 21 and sell 28. And if we do that, click on preview, And right there, it also figures it out. It says you are trading 7, but notice it doesn't show you the ratios. Down here, it gives you the full breakdown. You're buying 21, selling 28. So once you have the magic number of spreads, you can figure out that it's in a 3 by -4 ratio. So what that tells you again is that this trade, if it's filled as partial fills, it would have to always be buy 3, sell 4, buy 6, sell 8, and so on, all the way up to buy 21 and sell 28. You cannot fill it in any other ratios. And the reason is we know that we are trading 7 spreads in a 3 by 4 ratio. So for anybody who does trade ratios or back spreads, depending on your broker, that can be a very confusing topic and one that can also cause a lot of heartache if you thought you got executed, the trade's going your way, and you find out the trade got rejected. So make sure you understand how to break your ratio spreads and back spreads down into their component parts if your broker doesn't do it for you automatically. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.